US tech stocks just experienced a huge crash after the news got out about a new Chinese AI app similar to ChatGPT called DeepSeek. It has the same capabilities as Western world LLMs but was made for a fraction of the cost, precisely $8 million, while US LLMs cost tens of billions of dollars to train. What you have to understand is that China doesn't have access to any high-tech hardware produced by companies such as NVDA, and they are still able to create such a high-performance LLM. This would mean that US tech stocks are extremely overvalued, as there would be no need for such high-tech hardware to train these large language models. But of course, no one really knows if China is telling the truth regarding the cost of their DeepSeek LLM, and this means that this fear-fueled sell-off might just be the best opportunity for you to load up on some high-growth tech stocks. And first, let's have a look at NVIDIA, which is currently trading at $118, and over the past day it is down by almost 17%. But you can see that in the pre-market the company is already up by 5.33%. So jumping to my stock valuation spreadsheets, let's have a close look at the company. They currently get a rating of 7 out of 9 with 3 pillars in the red, and 2 of these pillars are the 5-year PE ratio, which is sitting at almost 70, and the 5-year price to free cash flow sitting at 65.75, hinting that Nvidia would be considered overvalued compared to their earnings and compared to their free cash flow. But what if I told you that this high PE ratio and high price to free cash flow can actually be justified by Nvidia's extreme growth? Their 5-year revenue CAGR is sitting at 65.23%, their 5-year free cash flow CAGR is sitting at 160%, and their net income CAGR is sitting at 163%. If I zoom into pillar 3, that is the revenue growth, the revenue has increased from 11 billion in 2020 to 61 billion in 2024. That is a 600% increase in only 5 years. So this extreme growth certainly justifies the company's high valuation. Now there are 2 more things I like about the company, and that is their high 5-year profit margin and their low debt. Let's first have a look at the profit margin. You can see that over the past 5 years it has been sitting at 30.57 on average. But if I zoom into pillar 6, you can see that it has actually been rising over the past 5 years at a very high rate. In 2020 it was sitting at only 25%, and currently it is sitting at 55.69%. And what is even better is that their return on invested capital is also rising from 15% in 2020 to 73.74% in 2024. And well, what this tells me is that the money Nvidia has been pushing into innovation has really been paying off. Now the last thing I love about Nvidia is that they have very low debt. Their long-term liabilities over the 5-year free cash flow negative dividends is sitting at only 0.28, which means that they can pay off all their long-term liabilities in about 1.5 years with the free cash flow they currently generate, so that is great. Now overall Nvidia is looking as a great growth company, but let's figure out if after their big drop yesterday they are trading undervalued. So first, jumping to the Grams formula revised, I will plug in my high earnings per share growth estimate at 50%, medium at 45% and low at 30%, average that out with the analyst projections to get a 5-year growth estimate of 39.36%, and we will get an intrinsic value of $58.11, which is 104% lower than the current trading price. Now for the second valuation model, the discounted cash flow model, we will plug in the free cash flow over the past 5 years and calculate the average growth rate to be sitting at 160%. Now as we are predicting the free cash flow into the next 8 years plus, I will project my growth rates a little lower. So I will plug in my high growth at 40%, medium at 30% and low at 20% and get a calculated growth rate into the future of 30%. I will then use this to calculate the future free cash flow into the 8 years plus. And then using the discount rate plugged in at 11.4%, I will calculate the present value of that future free cash flow. I will then sum all of that up, add cash and cash equivalents and subtract total debt to get an equity value, which I will divide by the shares outstanding and get an intrinsic value of $86.32, which again is quite lower than the current trading price. Now for the third valuation model, we will jump to the multiples valuation, where we will compare Nvidia to 3 of its competitors, so Broadcom, Advanced Micro Devices and Taiwan Semiconductor. As always, we will take this company's current stock prices, divide by their earnings per share and get their PE ratios, which we will average out and multiply by the earnings per share of NVIDIA to get an intrinsic value of $243.17, which is quite higher than the current trading price, showing us that NVIDIA would be considered undervalued compared to its peers. Now, normally we would also go through the dividend discount model, but as NVIDIA's dividend yield is sitting at only 0.03%, there really is no point going through this model. So we will jump straight to the ultimate valuation and average out the three valuation models and get an intrinsic value of $129.20, which is 9% higher than the current trading price. Now, one thing we do have to consider is that this intrinsic value was raised up by the multiples valuation. If I jump back to the multiples valuation, you can see that these three competitors, except for Taiwanese Semiconductors, are all overvalued compared to their earnings. Their PE ratios are sitting extremely high. Broadcom's is sitting at 156 and AMD's is sitting at 102. So we are comparing NVIDIA to overvalued peers. So if I was to remove the multiples valuation, the intrinsic value would actually come out to be $72.22, which is about 40% lower than the current trading price. And with a margin of safety of 10%, you would get an acceptable buy price of $65. So even with the company's big drop in share price, I personally wouldn't find it a great idea to invest into the company at its current trading price. But now let's have a look at the second company of the video, and that is Marvell Technologies, which is down by 19.10% over the past day. So jumping back to the stock valuation spreadsheet, I will plug in Marvell's ticker and wait for all the metrics to show up. And right away we can see that they do have a higher dividend yield than NVIDIA, sitting at 0.24% with a trailing free cash flow payout ratio of almost 20%. Now, when I jump to the 9 pillars, you can see that the company gets a rating of only 4 out of 9. So let's first have a look at their growth. You can see that their 5-year revenue CAGR is sitting at 16.72%, free cash flow CAGR is sitting at 52.20%, and net income CAGR is sitting at 80%. So they do have growth, but it is not as high as NVIDIA's. But you can see that their 5-year PE ratio is actually negative, sitting at negative 118, and that would mean that their net income is also negative. So if you jump to pillar 4, that is the net income, you can indeed see that from 2021 to 2024, it has been negative, so that certainly isn't a great sign. Now we also want to have a look at the 5-year profit margin, which is sitting at 4%, but if we zoom into pillar 6, currently it is sitting at negative 27.49%, and the return on invested capital is actually also sitting in the negative. So far it really isn't looking great with Marvell. They are also selling out shares at a rate of 5.30% yearly, which means that in the long term they are decreasing the value of your investment. And over the past 5 years they actually haven't grown their dividend whatsoever. So let's actually try and calculate their intrinsic value. But because they have negative net income, we cannot use the Graham's formula, we cannot use the multiples valuation, and because they haven't grown their dividends at all, we cannot use the dividend discount model. So the only model we are left with is the discounted cash flow model. So when we plug in the free cash flow, plug in the calculated growth rate at 28.3% into the future, and the discount rate at 14.2%, we will get an intrinsic value of $61.56, which is about 40% lower than the current trading price. But now let's move to the third and final company of this video, and that is Broadcom, which from yesterday is down by 17.40%. So jumping back to the stock valuation spreadsheet, we will again plug in Broadcom's ticker and wait for all the metrics to show up. And as always, if you want to download these spreadsheets for your own personal use, you can do so at the link in the description. And currently we are running a 20% discount, and you can find the discount code as well at the link in the description. Now getting back to the valuation, we can see that Broadcom does have the highest dividend from all three companies. The dividend yield is sitting at 1.07%. And the trailing free cash flow payout ratio sitting at 46.37%, which is nice and low and means that after paying out their dividend, Broadcom still has a lot of free cash flow they can direct into innovation, which is great. Now jumping straight to the 9 pillars, the company gets a rating of 7 out of 9 with 2 pillars currently in the red. Now, something I really like about this company is their high and steady financial growth. Their 5-year revenue CAGR is sitting at 17.55%, their free cash flow has been growing at a rate of 13.88%, and their net income has been growing at a rate of 32.52%. If I zoom into pillar 3, you can see the very nice steady growth in the revenue. The net income has actually dropped in 2024, but overall it has been growing very nicely, very steadily, and the free cash flow has been growing very steadily as well, growing from 11.6 billion in 2020 to 19.5 billion in 2024. So AVGO is performing some great growth in their financials. Now, something I do not like about the company is their high PE ratio. Their 5-year PE ratio is sitting at 37.86, but if we zoom in closer, it is currently sitting at 156.69, so investors are extremely overpaying for the company's earnings, and that is the similar case with the price to free cash flow, which is sitting at 49.79, quite higher than the range we would like it to be in. So again, investors are overpaying for the company's free cash flow. Though something I do like about the company is their high 5-year profit margin sitting at 23.83%, and their fairly low debt, with their long-term liabilities over the 5-year free cash flow negative dividends sitting at 1.77. Broadcom is also a great company for dividend investors, with their 5-year dividend growth CAGR sitting at 10.33%. If I zoom into Pillar 8, you can see that they have been growing their dividends very steadily and very nicely over the past 5 years, growing them from $1.34 in 2020 to $2.17 in 2024. So overall, Broadcom is looking very nice. So let's calculate its intrinsic value. First, jumping to the grams formula revised, I will plug in the 5-year earnings growth estimate at 15.89% yearly over the next 5 years and get an intrinsic value of $82.98, which is actually 144% lower than the current trading price. For the second valuation model, we will plug in the free cash flow. I will project a growth rate into the next 8 years plus of 9.7%, and with a discount rate of 6.9%, we will get an intrinsic value of $157.70, which again is quite lower than the current trading price. Now for the third valuation model, the multiples valuation, I will compare Broadcom to 2 of its competitors, NVDA and AMD, and we will get an intrinsic value of $96.35, again about 50% lower than the current trading price. And finally, moving to the dividend discount model, we will project a growth rate of 10.33% into the future, but as that is higher than the discount rate of 6.9%, the intrinsic value would come out negative due to the mathematics within the dividend discount model. And therefore, we will use our alternative model, which calculates the intrinsic value based on the stock price predicted by analysts and based on our projected growth rate and the next year's dividend. And using this model, we will get an intrinsic value of $242.12, which is actually higher than the current trading price. So now jumping to the ultimate valuation, we will average out the 4 valuation models and get an ultimate intrinsic value of $144.79, which is 30% lower than the current trading price. Now, if I was to actually remove the dividend discount model, we would get an intrinsic value of $112.34, which is now 44% lower than the current trading price, and with a margin of safety of 10%, we would get an acceptable buy price of $101.11, which is almost 50% lower than the current trading price. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.